Okay, well, we might get started. So, welcome everyone. Thanks very much for joining us today. Happy Friday. It's a bit gloomy actually today, unfortunately, but I hope you've enjoyed the last few Fridays now with our different webinars that we've been going through. Today, we're really going to be looking at planning your retirement. What does that actually mean? Now, obviously, today we're going to go through a lot of, I'm going to give you the fine print. A lot of what we're talking about today may not be appropriate for your personal situation. It may be, it may not be. So we're just on the fine print. This is general advice. So if you do need any personal advice, do feel free to reach out to us as well. I think actually I've probably met half of you on the webinar today, which is great, and you've probably met Bianca as well. So I'll be going through this webinar today with Bianca. Now, what we want to go through today on our agenda is really coming back with points that we hear from our clients when they're thinking about retirement. When are they thinking about it? But also some of the key things that are coming up in their minds. We kind of pulled it all together. We want to go through superannuation. How much is enough? How can you go about boosting your superannuation? What are some of the tax effective kind of super strategies that might be out there? Age pension, that doesn't excite us a lot, because what we want to do is get you to a point where you don't have to worry about the age pension, but we will touch on it enough to make you actually see why you don't want to have to worry about the age pension. We'll then go through a few examples and then on to estate planning. So let's talk about superannuation. And the stats actually say the average super fund, if I look at the self-managed super fund member balances, the average ATO stats show that those with a self-managed super fund have on average $911,000 as an average member balance, compared to those in retail or industry funds tend to have 402,000 is the average for members aged 60 to 64. Why is there a difference? Probably, we see there's probably, if you do build up your retail super fund balance, you might actually find that someone may be looking at investing in property if you go back to our webinar from last week. But also, I think an SMSF gives you the ability or more control to be able to work out what you want to invest in. I also do think there's a lot of cost benefits as well, that as your member balance grows, the cost as a ratio of or as a percentage of your member balance probably actually goes down, unlike on some of the retail and industry funds as well. So let's get started on looking at retirement and what is superannuation and why planning out your retirement is actually going to matter.
Let's have a think about why planning for retirement in your 40s and 50s is actually the sweet spot for retirement planning. I mean, why should someone like me in my 40s be starting to thinking about retirement? It seems so far away. I mean, I'm thinking about working, paying off school fees, feeding hungry teenagers, paying a mortgage, maybe renovating. During this time of our lives, we're not thinking of retirement. When you're at your working full time, you're at your income capacity, or you're nearing your peak income earning years. And this is the time to actually start thinking about retirement, with enough time ahead to put in strategies in place so that you can change the narrative for your retirement. So you're working hard, and is your super working hard for you too? And that's very important. So many of you today might have significant home loans, and we sometimes are in that mindset of, pay off that home loan, pay off that home loan. But the key is actually to balance that debt repayment, reducing interest costs and risks with balancing out the super contributions, so tax savings and also investment growth. So a blended approach we find works best. So paying enough onto the mortgage while also balancing out security, maximising super's compounding benefits, and getting a bit of benefit of the balancing of both. And then how do we balance to keep that on track? Allowing enough time before retirement to make meaningful contributions and then benefit from the compounding of those meaningful contributions into our super. So there is strong potential here to optimize tax by structuring our super contributions effectively. And strolling into retirement instead of sprinting offers a powerful opportunity. So every extra dollar that we put into super now can actually dramatically change and improve our retirement outcomes for later. And the right strategy will blend our tax benefits and investment growth to set up our final 10 to 20 years of working effectively. So when we talk about balancing, we look at firstly, there are some things that are great financial outcomes, and obviously we love great financial outcomes, right? So secondly, there are some things that are great tax outcomes. Clearly, we love these too. And then thirdly, there are just some things that satisfy our goals. And this third one, which can often be the most important, is just literally because we want to, we feel we need to, it is important to us. It's called take the kids to Disneyland while they're young before they don't want to hang out with us. So let's meet Lisa. So Lisa is 52. She's working full time, earning $110,000 a year before tax. She has a mortgage balance of $180,000. She has 5.7% interest rate on that. Her super balance is $220,000. Lisa has $15,000 extra a year after expenses. And Lisa's wondering, should she use her surplus to pay off her mortgage, or should she make extra contributions into superannuation? So let's have a look at the financial impact of each option to help determine the most effective strategy for achieving Lisa's retirement goals. And that's where we can financially model out Lisa's retirement. You know, we can even model out your estimated superannuation at life expectancy. Did you know that? So does Lisa put money into her super or into her mortgage? So in scenario one, we can see here that Lisa pays off her mortgage earlier by directing her extra funds to her additional home loan repayments. So clearing her $180,000 mortgage in around 10 and a half years just before her retirement. And while this results in her owning her own home outright, there's no tax benefits on the repayments, and her super grows slowly through the employer contributions only, her super reaching around $390,000 by age 65. In scenario two, Lisa uses her $15,000 extra to salary sacrifice into superannuation instead. So with this surplus into concessional contributions into super, she's benefiting from the lower tax rate of 15% in super versus the higher marginal tax rate of her 34.5%. Her super grows to approximately $520,000 by retirement. And although she retains a $62,000 mortgage, we're actually then at retirement going to take that lump sum out of Lisa's super, so that in scenario two, Lisa's super balance will actually be $458,000 after we take that lump sum out and pay off her mortgage. So Lisa effectively in scenario two is actually better off by $68,000 at retirement in her superannuation. So scenario one may appeal to those prioritizing that peace of mind from being debt-free. And this is going back to those balancing goals, that third one of, you might just want to achieve something because you want to, you feel you need to. It gives you that satisfaction. It helps you sleep better at night, knowing that your mortgage is paid off or under a certain amount by a certain age or a certain time. Scenario two is more about the first and second balancing points that we've mentioned earlier about having, something that is a great financial outcome and also a great tax outcome. So even after repaying her mortgage, that lump sum that she has in super is actually $68,000 better off. So this comparison highlights that trade-off between reducing debt and also maximizing retirement savings, with the super strategy producing the higher financial asset due to the tax advantages and also the compounding.
And sometimes that financially modeling it out, as Bianca's talking, financially modeling it out, Lisa may be the type of person who's used to, this mindset of I need to pay my mortgage off ASAP. I can't do anything else outside of that. But after sitting down with Bianca, and Lisa is based on a true story, after sitting down with Bianca, Lisa changed her name to make everything anonymous, was actually, I guess you could say, empowered to make a decision of putting that money into super knowing that at retirement, because we're financially modeled it out, at retirement, she was not only going to have her house paid off, paid less money to the tax man, because honestly, they don't use it that well. They don't need any more. And she'll have a so higher super balance and no mortgage. So I think that what Bianca had done with this particular client had actually gave someone who was quite a nervous Nelly and wanted that home loan paid off ASAP to having the confidence to make the decision and say, Bianca, okay, I get it's a better tax decision to pay that extra 15 into super. I get that it's a better financial decision. And you know what? Now that you've done my financial modeling and you've modeled it out of 10 years, I actually will sleep well at night because I know that at retirement, I'm going to be better financially off. I've paid the taxman less money and I will have the home loan paid off. And I think giving the strategy and I guess a lot of advisors just give strategy. We love numbers because I guess the accounting background. So that's why we love financial modeling. But I think giving such a strategy and financially modeling it out was where Bianca's client was actually able to say, actually, no, I'm going to sleep well at night because I know you've got it covered and I know you've modeled it out. So it really, it was a great one to use as an example about having that kind of strategy there for
It
them.
really, yeah, it comes down to those personal goals because when we're working with clients, we're not just modeling out the next 5 or 10 years. We can actually model out through to life expectancy,
Yeah.
which, by the way, the government says is for men is 87 and for women is 89. So we'll add another 5 years just to not to jinx you. And we can actually financially model out, your super balance and what that would be at life expectancy so that you can plan out between now and then and work out what you will need and what we can do in the meantime to boost that to have a bit of an increased super balance.
Yeah.
So when it does come to affording a comfortable retirement, your super is one of the most valuable assets that you have, along with your home. And Australia's super system is designed to encourage us to save money for our retirement, and we are very lucky with that. So the super system is designed to make regular contributions into our super accounts, and these contributions are then locked away by the super fund, who invests the money. If it's in a retail fund or if it's in an SMSF, then you as the trustee then have the privilege of investing that money, of course, within the rules. And then you can access that money to fund your retirement. So in Australia, your employer, if you're employed, pays contributions into your super, which is currently 12% of your income. And then these contributions are known as superannuation guarantee or SG. So what does this actually mean? So this has meant that your SG is going into your super, accumulating your wealth. So when you're working, contributions are going in, your super fund is invested, and then from age 60 and once retired, you can then access your super tax-free. And if that money was outside of super and you're age 60 and retired, not tax-free. And not everybody knows this. Because it's in super, the investment earnings in the pension phase are now tax-free. And so how much is enough? When do you want to finish work? It's not all a one size fits all. Did you know that you can actually make extra voluntary contributions on top of your employer's SG or superannuation guarantee payments, up to the concessional contributions cap? And we will touch on that in a moment. So preparing for life after work. So planning ahead is essential to ensure that you can afford a comfortable retirement. And the key is to work out how much superannuation you'll need. And this is where we can help you. Working backwards to create a plan that will help you reach your target while you're still working. And that big question, answering that big question for you, how much is enough? And on the safe side, it's really good to plan out at least 25 years of retirement funds once you've retired. Keeping in mind that your spending may change from going from working to retirement. you might be taking more holidays in retirement or planning to, so you might have, that extra bit that you're wanting to spend and enjoy while you're in retirement of those holidays. Do you have a specific retirement age in mind, or would you look at gradually retiring? We don't want you to be retiring and then doing nothing, because that's when people pop off the perch. So it's really good to, financially have goals, but also, interlinking those with your personal goals of having things planned and ready to go. And when they are, you want to have those funds so that you can actually do those things when you have finished work. When we're working with clients, we're looking at, keeping them healthy and active, both, mentally and financially, working with them on their current and also their long-term goals and what they're wanting to achieve. So we're just going to pop a slide up of information according to the retirement standard, which is released once or twice a year. And this just shows the average income for singles and couples living in modest and comfortable lifestyles. So a comfortable lifestyle is then having, as a couple, $690,000 combined in super and having your house paid off. Needing just under $74,000 a year in income to provide for that comfortable lifestyle. So we want clients not to just have a comfortable lifestyle, we want them to have an amazing retirement, amazing retirement lifestyle. So we're thinking at least $100,000 a year in retirement so that you can have lots of holidays and family time. So let's use this comfortable, modest lifestyle income as a base that we would work from and then move up from there. We're also going to touch briefly on the age pension and why. Because we're hoping that you're not really needing the age pension because we've worked hard and made you so much money that you're self-funded retiree. And that's what we want for you. But if you do need the age pension, we do live in a lucky country where we do have the age pension available that can put food on the table. So if you do have that superannuation and you are taking those big holidays and you're enjoying it, that's great. And then if you do run out of funds, then obviously depending on your age and residency requirements, you do have access to that government pension from age 67 onwards that can then assist you with your bills and food. So let's touch on what your entitlements are for the age pension. And this is why we want you all here today to be self-funded retirees. But if you do spend that money in those first few years of retirement, then these are the figures that you are eligible to have as the age pension. So this,
and we have seen that happen, haven't we? We've had clients come to us who had a really good age 60 to probably 65. They've come to us at, oh, sorry, 60 to, I think they came to us about 73, and they literally spent all of their super and then went, okay, now we have a problem. They had a great retirement so far. So they didn't plan it out.
Okay.
They came to us at that age. Now, look, they were actually eligible then for the age pension, but it's something that, we would hope that you don't need it because you're self-funded and you're living not just a comfortable lifestyle, you're living a very enjoyable one.
Yeah. And if you do need it, we can also include this into our modelling for you as well, so that you do know ahead when your super would run out, if it is going to run out, and then we can include your age pension income as well. So you will still be fed.
Yeah.
So we can see that the age pension, while it is extremely helpful, isn't really enough in itself to fund a comfortable retirement lifestyle. And that's why it's important to maximize your super while you're still working. So how do we go about boosting your super?
So we don't need that age pension.
Yeah.
Yeah.
So as I touched on just before, superannuation guarantee, that is a concessional contribution into super, that is one of them, and that is tax deductible. So they're called concessional contributions, don't know why, it's not really a concession, it's a tax deductible contribution, which your employer pays, or you can salary sacrifice or make a personal deduction into super and claim as a concessional contribution. There's also the non-concessional contributions. So that is taking money that has already been taxed from outside super, taking a lump sum of money and putting it into super. So currently we're looking at concessional contributions caps of $30,000 each financial year per person, taking into account that this includes your superannuation guarantee, as well as any salary sacrifice, as well as any personal concessional contributions that you may put into super. The non-concessional contributions cap is currently $120,000 per financial year per person into super. So you could take a lump sum, say if you had an inheritance, and put that into super as a non-concessional contribution. And you can also do the bring forward rule for non-concessional contributions, where you can actually use up to 3 years of those types of contributions. So you can actually put in a lump sum of $360,000 as a non-concessional contribution. But if you are going to look at putting in extra contributions into super, whether it be concessional or non-concessional, please reach out to us and have a chat, because it is very important that you do get these right, because you don't want to put in too much and then be penalised for that. There is also another way to boost super if you do downsize your home and you're over 55. There are a couple of rules to follow, of course, but you can put in $300,000 of downsizer contributions into superannuation each from the sale of your home. So understanding the right contributions at the right time can actually make a significant difference to your retirement savings, especially in those years leading up to retirement. There is also another contribution that we can have a look at, which is having a look at salary sacrificing. So that can be an easy tax-effective strategy for growing your super, particularly if your marginal tax rate is high. And this is how it works. You can make an arrangement with your employer, authorising them to take a set amount out of each of your paychecks before your income tax is deducted from your income. And then your employer then deposits this amount into your super account the same way that they would with your superannuation guarantee payments. And the benefit of this is that you don't have to pay the income tax on any of those amounts that you do salary sacrifice. So instead, these amounts are generally taxed at a maximum 15% when they go into your superannuation account. So even though your super contributions are taxed at that 15% tax rate, for many people that will actually be lower than their marginal tax rate, which could be as high as 47%, including the 2% Medicare levy. And what's more, sacrificing part of your salary can also reduce your taxable income. So win-win. And this could potentially put you down into a lower tax bracket as well. And then there's also the unused concessional contributions. So if your superannuation balance is less than 500,000 at the 30th of June at the end of the previous financial year, you may be entitled to actually do some top-up concessional contributions up to the previous 5 years of concessional contributions caps. But please, again, have a chat to us before you go ahead and do that, just to make sure that you're not penalised if you put in too much of those contributions. So having a look just at the non-concessional, and I have touched on the different caps here, putting those into super. So we do have the non-concessional caps of $120,000 a year. And we also have the bring forward, where if you haven't contributed up to your cap for that year or the previous couple of years, you can actually use the bring forward rule and get a bigger amount of lump sum into your super by using the non-concessional bring forward feature. And just touching on some other super strategies. So there is the government co-contribution strategy, and this might be really good for your young adult children if they're earning under that 47,488 per annum. If they make contributions, after-tax contributions into super, then the government will match those contributions up to the maximum of $500 into their super. So say, for instance, they put $1,000 for the year into super, then the government will then co-contribute $500 into super for them as well. And it's really lovely in that this is actually automatically done. So if they do that contribution for the year, the ATO will automatically pop that extra $500 in there. So winning again. So touching on another super strategy is spouse contribution splitting. So this is an amazing strategy that you can be advised on. You do need financial advice for this strategy, and your accountant is not able to do that. So I know Shannon's sitting there busting to do something with this when she's in her accounting meetings, if it's not a advice client as well. So you do need advice on this, but the beauty is here that the high income earner can contribute up to their concessional contribution cap of that $30,000, and then they can take up to 85% of that $30,000 and actually transfer it to their spouse's superannuation balance. And the reason for this is then that you are building up that spouse that has the lower superannuation balance, because there's a few milestones that this can assist with in your superannuation balances. You know, the 500,000, $2 million mark, $3 million mark, preservation age. You know, important to reduce the bigger balance and build up the other one to kind of equalize those balances. And this can be effective later on, especially when you're coming up to retirement or are retired with the transfer balance caps. So the super contribution splitting, that's a strategy that allows you to transfer a proportion of spouse A's concessional super contribution from the previous financial year to spouse B's superannuation account. You do need to just check with your super fund that you can do this, or if you have an SMSF, that's great. You can do that.
You can do whatever you want in it,
Yes.
provided you do it within the rules. But
Very
that is
flexible.
one of the beauty of a self-managed super fund, is that you can make some of these decisions as we're preparing the accounts.
Yeah.
It gives us a bit of flexibility on that side. Yeah. So then if we want to look at, why would you want to put some of these investments, what's a tax effective investment inside super versus outside of super, and why would you do one or the other? And this is where it can really come down to your personal situation and where you're at in life. You know, where are you at financially in life? Where are you at age-wise, work-wise? And it will differ. You know, if someone said to me, I want to buy a factory to run my business, and I would like the money that I'm going to get ultimately if I pay some of that factory down. I want some of that money today, because I'm going to do that and buy another one and do things like that. And I need the money outside of super, i.e. they need the money before they're 60. Then you may choose to do an investment outside of super because they need the money outside of super before age 60. Whereas if it was a case of buying that factory that you're going to run the business out of, and you're not going to touch any of the, I guess, say, profits from that money that you're investing, then, you know, until you're 60, you don't need it. It's out of sight, out of mind. Then why would you not put it into a self-managed super and have it, as Bianca said, when you get to age 60, you own the factory outside of super, it earns income, you pay tax, normal tax rate. You own the factory inside of super, you're at age 60, you're in pension phase, zero tax. You decide to sell the factory, zero capital gains tax. So there's a lot of different opportunities. So how does that differ when we're looking at outside of super versus inside of super? And this may even be an investment portfolio that you may be looking at some money that you've received. You know, if you put a $450,000, if you had 450,000 outside of super, now we've just assumed a 7.7% investment return. Now that's at a benchmark interest rate. We always try and overachieve that, obviously, in our investment returns, double digits. But even if you set a 7.5%, trying to be really conservative, year one, your return would be 34,650. The same inside of super, it's getting the same returns, let's just say. But what's your tax difference? The tax outside of super is going to be 11,954. At 15 cents in the dollar, it's going to be 5198. So a position after year one, 472 versus 479. But after year 10, as it keeps going through, and this is on the assumption you don't need that money, you're not needing any of the investment returns that are being earned on this particular portfolio. After 10 years, outside of super, you're going to have $736,000. Inside of super, so this is really looking at a share investment portfolio, you're going to have $112,000. And you've got an additional benefit. So that's where, when we're speaking with clients about your overall goals, what we're trying to understand is, if we do investments, is it an investment? Where should we be investing? Maybe you love property like I do. So all of a sudden you're on a self-managed super fund and you're investing in property. You may actually still have property outside of super as well, because sometimes property outside of super serves its purpose just nicely for negative gearing. If it's, say off the plan, brand new, high depreciation. Even at the moment, you've got the government doing the stamp duty reduction at the moment, but you may do that outside of super because you're getting the tax benefit at negative gearing. So when we're going through this with clients, we're really trying to work out, what are your goals? What are your goals in the next 5 years, 10 years? How old are you and how do those goals align? And do we need the income from this investment? But you can really see, if you don't need the income from a particular investment, then actually buying it in super could be really beneficial. Where I see some of that benefit, depending on someone's age, again, all fact specific, but looking at if someone's buying shares in, and it could be buying shares in a business that's maybe not going to get much in the way of dividends, but the capital growth is expected to be there over a longer period of time. So it may be in, some of these startups and things like that. Sometimes those can be great in super because you're not going to be probably getting any investment return between now and, a little while. But if it does go up a lot, you have the opportunity that if you're at pension phase at that time, then it's all tax free. Even if you're not at pension phase, capital gains in your super fund works out effectively at 10%. So it's still, you can't grab the cash now, but the tax rate's still quite generous. So I guess what we look at is, when we're looking at creating a portfolio, so, whether it is shares or whether it is obviously then property, but what you're trying to look at is growth investments. When you're doing your portfolio, growth investments, high return, yes, high risk. If you've got a long time till retirement, then maybe you can afford that extra higher risk potential to get the higher returns because you've got a really long time to go. If you're very close to retirement, you may actually want to be a little bit more wound down on that and be lower risk, lower volatility, because you need the cash flow. Now, what we've been doing with a number of our clients, and it comes down also to your superannuation balance. I don't just have one investment portfolio with my clients. What I'm starting to do is actually have a number of investment portfolios. Why are we doing that? Depending on their superannuation balance, I might want to have one investment portfolio, and this is more for clients that are actually at retirement or a year or two off retirement. And I might have one that is on that defensive side, where I'll have, say, 2 years, maybe 3 years worth of retirement funds. So if we go back to what do you need to live on, and the government said it's around that 70 mark, and I'm saying it's actually 100, so you can have some really good holidays. But let's say that's 100,000. Well, I might put 300,000, 200 or 300,000 into a more lower risk investment portfolio. And then I'll have the balance. Potentially, I might have it in 2 or 3 different portfolios, depending on the client. If they're a bit younger, I'll have less in the, in the low risk. But I might actually, even if I'm down to 2 investment portfolios, have the rest of the funds in a higher risk dash potential higher returns. What that means is, if the market collapsed tomorrow, my client can still sleep well at night to know that's okay. Yes, your share portfolio may have dropped, and the higher risk dash, well, I say higher returns, maybe it's gone down a lot, is in part of their superannuation. But the other part that we're relying on to get income so that they can actually pay the bills and food and everything like that, we've got either 2 to 3 years, depending on the client's appetite to risk, sleeping better at night, it'll be 2 to 3 years, meaning they can turn around and go, fine, I actually don't have to get stressed about this for, 2 to 3 years, because, and let the market do its thing. Let the market do its thing and bounce back from that perspective. And they've got that amount as comfort from that side. So it's really about when you're tailoring a portfolio, it's not just saying, okay, oh, I want to invest in this and just putting it in there. Sometimes with the self-managed super fund, when someone goes into a property, that will be their biggest asset because they had to put literally everything they had into it to get the property. But once they've done that, I'm always saying, let's not go paying off that loan ASAP. Let's just let that tick on. Let's put the additional money that you're getting from your superannuation contributions into an investment portfolio. So we've got two assets growing, the
Yeah.
property and the portfolio, not just one. And then looking at how do we, once we decide that we're going to put it into a portfolio, let's really think about what your goals are. Now, maybe you have a lot of money, lucky you, outside of super that you've got a number of years that you don't have to worry about tapping into your super. Then I'm not going to put anything in that low risk defensive investment at this point in time. I'm going to potentially keep that in growth and at a certain time. So this is where we really work a lot with clients to say, where are they at? How can we help? And how can we change the portfolio and adapt it to what your actual needs are as well?
Yeah, and there's a couple of ways to go into retirement as well. So the transition to retirement or a TTR strategy, that is one way. So if you're wanting to ease into retirement, this can work well for some clients because it enables you to start accessing some of your super while reducing your hours working. And then you have your super income and also your work income, so that's equaling out still what you were earning. But then you're still having that, pleasure of doing your work and having income as well. So you do need to have reached your preservation age, which is now age 60, to enable the TTR strategy. But you can actually also keep making the concessional and non-concessional contributions into super while you are drawing that TTR income stream from your super at the same time. So it's very flexible, but I would definitely suggest that you come and see us before you actually enable this TTR strategy, because it is actually a very complex strategy to have a look at.
It
And
used to be fantastic many years ago. It was
different, yeah.
literally, we used to have lots of fun and games. We enjoyed it, let's just say. It was a bit like a round robin. You got to take money out, put some in, you had no tax. It was really great. Government realized they'd actually screwed up on the legislation when they first put it out there and then buttoned it up. And now we're at this, yeah, it's okay. It's good. It means you can semi take a step back from work and that, but it's not as good if some people still come to us and go, oh, I've heard it's really great and you can do all of these things. And every time there's a bit of fun and a bit of a party happening, the party police come in and the ATO close that down. So that's kind of pretty much what's happened. But it does give you, like as Bianca was saying, that ability to top up, reduce your work, top up the income that you would have had and keep going on that side.
Yeah, and there's definitely some pros and cons with the transition to retirement. So, it can allow you to access the portion of your superannuation as income while you're still working, so you don't have to fully retire if that's not what you're wanting to do. So it can, supplement your salary, does have tax advantages. It helps, increase your retirement savings because you are still able to then contribute to super as well. But there are then some disadvantages to the TTR. So it can actually deplete your super balance. So it is really good to get this cash flow modeled, because you don't want to be doing a TTR strategy and then 20 years later running out of money. You cannot access your super as a lump sum. There are some drawdown limits between 4 and 10% of your super balance. And there are also contribution caps that can apply to limit the effectiveness of it. So it is really good to just touch base with us before you actually look at doing the TTR, and we can model that out for you, helping you, look at your financial situation to determine whether that transition to retirement strategy would be right for you. And then when you do retire, you'll need to make important decisions around what to do with your super. So there are three main options. You can leave your super where it is, and you won't receive regular income. You'll continue to pay that 15% tax on your investment earnings, and you may choose to do this if you have assets outside of super that actually provide you the income that you need to pay your living expenses. So once you get to retirement, you don't actually have to then transfer your super into pension phase automatically. You do have the choice of, if you do have, say, an investment property or shares, you're earning income off those, and that's enough for you to live on. You might retire, live off those investment assets that you hold personally before you actually then transition your super from accumulation phase into pension phase. Option two is cashing it out. So a lot of retirees actually believe that once they retire, they need to cash their super out or take a lump sum. So you can take a lump sum once your super is in pension phase if you want to, but I would suggest, depending on the person, leaving it in super so that it actually has higher returns than you taking that money out. And it's also then in that tax-free environment as well, which is really important. And then the third one is converting your super to an account-based pension or an annuity as well. So that's another option. So if we have a look at account-based pensions, so they can provide you with a regular income stream, depending on the super fund, or if you have a self-managed super fund, you can set up your own regular pension income from your SMSF. Once you've reached preservation age, so now age 60 and retired, then you can access your superannuation and pop it into pension phase. And just remembering that the more that you do invest in that pension phase, the higher the investment earnings, the more income you receive over time from your pension account. There also is the annuities. So that is an option to have a look at, which these can be held within super as well as outside of super. So if you're looking at using money from your superannuation, there are a couple of different types of annuities. We can look at lifetime annuities, where you're actually investing that money still within that super environment, still tax-free, investing it for a lifetime. So you're actually putting that lump sum away, but you're getting guaranteed income for your lifetime. And that's usually paid on a monthly basis. There's also the annuities, which are fixed term. So again, in super, still tax-free income, and you're paid a guaranteed income for a certain period of time. And that time will depend on, what we model out for the fixed term annuity. It might be a 5-year time frame, or a 10-year time frame, or a 20-year time frame. We'd have to have a look at that. The beautiful part about the annuities is actually the whole asset is not tested for Centrelink assets. So if you are, as we touched on before, if you are on the government pension and you are relying on that income and needing it, then an annuity might be a really good option.
Yeah. We had a really great one, actually. We should have put it in as a case study. One of our clients convinced their parents to come and get advice and their parents were, was it late 70s, I think, around the late 70s. Convinced their parents to come and get advice. That took a bit of a convincing because they thought they didn't need advice on anything. And they had an investment property that they'd had for years. It was actually, in a sense, positively geared, but really the investment return on what the asset was worth, the money that they were getting in rent was not a huge amount of money relative to what the asset was then worth. So they did actually come to us, obviously had to pay for our advice to do that. The outcome, it has completely blown them away. I think they're going to send every single friend that they've had. The adult kids could not believe it as well. But what we're able to do with the annuities is they've sold this property, and we actually put, we put some into annuities, and we've actually done it into a few different annuities. We've planned it, different structures of them, and we've actually planned it. So the end result is they are now getting more income back than they ever had before because they were worried about replacing the rental income that they were getting. They're now getting more income back than they ever will before. They don't have tenants ringing to say that, things are broken and this all needs to be changed. They don't have to worry about it. And we've financially modeled it out, and they are so much better financially in years to come when we look at it, past life expectancy. I always had 5 years, as Bianca said. We always had that on. We just kept modeling it out. But they were actually blown away. And the reason, as Bianca said, is the fact that, you have this money in annuities, but not all of it is assessed from a pension perspective. So we increased how much money they got from the government, and they've got this regular annuity. So they've actually got more money now as a result than they would have had before. And they gifted a heap of the money that they got from the sale of the property. They gifted some of that to the kids. So it was a really great outcome on how it's not even just maybe a one annuity, it might be two or three, and we have some are shorter and longer. So it's a bit of playing around with it, but the impact can be huge.
It can, it really can. Yeah. Another thing to have a look at with retirement is the transfer balance cap. So you may not have all heard about this, but there is a certain cap, which is currently $2 million, that you can put into retirement phase or pension phase in super. So once you reach retirement, if you have $2 million, you can transfer that from accumulation phase into pension phase. Happy days, get a payment of your income stream, and off you go. If you have over $2 million in your super, then that means that you can transfer $2 million into your pension phase and start your pension or annuity or whatever that might be. And then the amount above that $2 million cap, you didn't need to retain in that accumulation phase, or you can draw out of superannuation and pop into your personal cash flow. This just means that everyone freaks out about this. It's not that big of a deal. If you have money sitting in the accumulation phase of super, you're only getting taxed at 15%. So it's not actually getting taxed at your marginal tax rate. It's less tax. So it does still work for some people to keep that money in accumulation phase if they do have more than the transfer balance cap. This is also another very complex area that we need to model out, because if someone has already started a pension, the transfer balance cap will actually be initiated at the time of them starting the pension and not the current transfer balance cap. So this is, a very big tip to be aware of.
Yeah. And it depends on the person. It'll be in your super fund records, whether it be retail or self-managed super, but it's a really it's a nice big convoluted calculation, because the tax office, of course, couldn't do a simple one based on your age and all the rest. So
And then just touching on estate planning. So I'm not sure if you're all aware, but your personal will does not actually take into account your SMSF assets. So you actually do need to put in place an SMSF will to ensure that your superannuation assets held in your SMSF are taken care of and are inherited to your chosen beneficiary by way of an SMSF will. It's also important to seek, to seek legal advice on these matters relating to your estate planning, both personal and with your SMSF. And we can actually assist you. We do work with estate planning lawyers, so we can give you the guidance on this that you need.
Yeah, we started working with a lot of lawyers on estate planning, because we'd meet with clients on their financial advice and say, so have you met with that lawyer to get your wills done every year? And it'd be, oh no, I'm going to. So now we're like, okay, let us get this all sorted. Let's provide the information to the lawyer and let's get it done. So we're really happy to say, I reckon years ago, only 1 out of 10 clients had their wills in place, and I would say it's 9 out of 10 now, which is really good to see, because at the end of the day, you don't want issues later. So how we can help you as advisors, help you set your lifestyle goals, work out what it is you want to do, maybe ask those questions to try and get it out, get you thinking about it, work out how much you're going to need. Now, obviously, there can always be, needs and wants, and we'll try and balance those out, and hopefully you can get what you want, not just what you need, and build your super savings. So you still get to enjoy life today, but with super in mind, but not enjoying today at the expense of tomorrow as well. And that's the balancing act that we need to do. Relying on inheritances, I don't think not a great strategy for your superannuation. Personally, I'd rather to never get an inheritance and still have my parents around. And I think, sometimes we hear people say, oh, I'll get an inheritance. You know what? Let's have our parents live for as long as possible. So that is not a good super strategy if that's your pension, your retirement strategy. Really try to take control of your cash flow. How can we pay off your debts? But pay off your debts in a way that's going to work out advantageous over a period of time. Thinking back to Lisa's situation as well, we definitely put Lisa. Lisa's going to be in a very good situation when she gets to retirement because you had the information, and then secure your family's future, and help you access some of these social security benefits and protect your loved ones and prepare for retirement and really enjoy it. And when you've got that peace of mind, that's kind of the goal. I mean, I do always say to people, oh, but look at this strategy I came up with, and what about this great strategy? And I get really excited. And so many people say, I just actually sleep better at night now that you've gone through it all. And so I guess it's kind of, life moves. And that's why when we're working with clients, we keep just changing as things happen. I had another call this morning with a client and things are completely changing. I need to go in and have a look and see what that's going to be like. So I'll open it up now to see if we have any questions. Let me just see. We don't have any. Oh, there we go. At what amount? At what amount would you consider establishing a self-managed super fund compared to leaving it in an industry fund? So we did do a webinar on this, so do have a look at our YouTube on whether to consider is a self-managed super fund right for you. Now, when it comes around to, in theory, the rules on it, there is no minimum requirement when it comes to a self-managed super fund, but advisors cannot advise on anyone that has less than 200,000. In super, and that's combined balances to go into a self-managed super fund. And that was really to try and protect consumers from, there were a lot of dodgies a number of years ago. We all saw that situation as well. What I kind of say to clients, look, at 300 to 350,000 combined super, so if you had two individuals with two separate super funds, versus 350 in a combined self-managed super fund, not necessarily invested in property, just invested in shares, your fees are going to be about on par. I would still say to my clients, if you're not looking at buying a property, I would say, can you really be bothered being a trustee of a self-managed super fund and having to, coordinate getting the accounting done? And obviously we can help you with all of that, versus your retail fund or industry fund, you don't have to worry about that. So at 350, I kind of say, would you bother? Even at 500 combined balance, I actually say to people, okay, for that extra, you now have to do something and do that self-managed super. And if you are going to invest it only in shares, which is what can be done in your super. And look, the super funds these days, the retail super funds do have some flexibility on some of the funds that we work with to really split your funds up and do some other good creative things that you can do. Once you've got a combined balance of over 500,000, for me, it's nearly kind of a no-brainer to go into a self-managed super fund, provided you're happy to do the compliance aspect and we can help you with it, but know that you're going to have to do that. There is a benefit because cost-wise, our accounting doesn't really get more. The auditor doesn't really get more when it goes from 500 to 600 to 700,000, whereas it does get more when it's in your retail fund as well. But if you're looking at buying a property, then obviously you need a self-managed super fund. Yeah, so can you leave inheritance from super to your independent children without them being taxed further? That's probably come out the forefront. People are probably a bit more conscious of that now. So with superannuation, you have, and this might get a bit more detail than anyone ever wants, but just so that you're aware of this, superannuation is governed under the SIS Act. And you need to be basically a SIS dependent. Now, with between spouses, you are SIS dependents of each other. So when super goes from one to the other, that's okay. That we don't have the tax consequence from that perspective. When superannuation goes to a SIS dependent, so your kids are under 18, they would be SIS dependents. Or if you had a child that was dependent on you, maybe a disability, then they would be a SIS dependent, and then we don't have the tax consequence. When it's going to your adult children, so if I was to inherit and I'm not dependent on my parents, then you do have this, and this is where it gets kind of confusing for most. We don't have inheritance tax. So if I was to inherit from an investment portfolio outside of super, no tax. That's fine. There's no tax because we don't have inheritance tax in Australia. Don't give the government any ideas. I mean, I deal with quite a few clients that are from the UK or have dealings with that, and obviously they do. But if the money is coming from superannuation, there is an extra tax on it, and that tax is 17%. And that's on that's when they inherit. Now, what I would recommend, this where it gets again, go and seek personal advice, get your advice on this. Having a look at your superannuation balance and seeing what is your tax-free superannuation balance and what is your taxed super balance. Your kids can inherit your tax-free super balance, no problem. And that will be tax free because that money went into your super fund, probably non-concessional, and then so that you can take that back, they can take that out tax free. With the taxed amount, that's where when it goes to your kids, and I've seen clients get it where, and they get literally like a payment summary with no tax withheld from like say CBUS. And I had one client got $100,000 from their dad's super. 100,000 no tax, so they took the 100 grand. They're pretty excited, didn't realize there was a tax consequence. So there is some structuring you can do around that, and and that's where it's worth planning out. And that's where when we're leading up, depending on the age, depending on your super balance, we might try and do some round robin. So when Bianca talked about the non-concessional, if I see a client that they've now got to preservation age 60, they can access super. And they're under the caps, the overall caps, then I might start doing a round robin every year. I might start taking money out of their super because they can, a lump sum, and then non-concessional put the money back in. What am I doing? I'm taking money out that's got a non-tax, tax-free and tax component, and I'm putting money in to increase the weighting that I've got.
To make it all tax-free, yeah.
But yeah, so there's some strategies. It's really look, if we all knew exactly when we were going to die, we'd be able to plan better around that. I have had a situation with a client where the mother got very sick, and as morbid as it sounded, then they had about $1 million in super, and I ended up having to I contacted them and I said, look, you've got to get those, well, give us a thumbs up to get those shares and that money out of super, because I was then advised that they thought she had 2 weeks to live in her 70s. And so we got all of that money out of the self-managed super fund. Otherwise, you would have been taxed at your 17% on all of that. So if we can plan out that part, as much as we can control, there's some benefits. The tax treatment of another question on tax treatment of the income to members and earnings within the fund during the transition to retirement. I guess with that's the transition to retirement, we'd have to look at the specifics on age and that situation. As far as you've got two balances in the in your superannuation fund, you've got an accumulation phase and you've got pension phase. And so when you're in that transition to retirement, it depends what you've probably got in your balance is probably still in accumulation. You've got some of that. So it depends on the two accounts that what your income is in. Whatever's in pension phase is then at that zero tax. Whatever's in accumulation is being taxed at 15 cents in the dollar. The money you have coming out, there's a nice big convoluted calculations depending on age, etc., on the tax treatment that we'd have on that side of it as well. So I think that's answered all those questions. So I hope that's inspired you to all get ready for retirement. It's something that and this recording will be onto our YouTube. You can have a look at some of our others if you did miss the last two as well, where we focused on self-managed super fund, but we do have others there. But I think it's never too early to look at your retirement situation. I've also recording a podcast with some little ideas that I come up with here and there as well. I've talked quite a bit on especially what you can do with maybe kids, grandkids, investment bonds as well. So we do have our podcast. But if you have any other questions, feel free to reach out. Happy to help. Bianca and I can assist you in any of your retirement planning. And I do believe it's never too early to plan it out. As Bianca said, you want to have a bit of a stroll into retirement. You don't want to be that person that comes in at 58, 59. I can still tell you at 58, 59, we can still do wonders, but our magic wand can do a certain amount. It just can't do all of the things we'd love to do if it was an extra 10 years on our side, but there's still wonders that we can achieve at that time. So thanks everyone for joining us. Have a great weekend, and we will speak to you all soon. Thank you.
Thank you.